The IMF just told us the global economy was heading for its best year in a decade. Then the war in Iran happened. Today, what actually cost Canada, why the OECD's breakdown of Britain's tax code should make Ottawa uncomfortable, and the private credit story your Canadian insurer isn't leading with. Welcome to the Daily Brief Canadian Macro. I'm Steve. 3 stories today that the mainstream is touching but not connecting. First, the IMF dropped its World Economic Outlook this morning. The war erased what was supposed to be a global upgrade. Then the OECD lit up the UK's tax system last week, and when you hold it next to Canada's, the mirror isn't flattering. And finally, the private credit risk that Euro-Dollar University flagged in US insurers? Well, Canada's big three are building the same exposure right now with your retirement savings behind it. Let's get into it. Before the war started on February 28th, the IMF was preparing to upgrade global growth for 2026 to 3.4%. They didn't get the chance. The IMF downgraded its forecast to 3.1% and marked up its expectation for global inflation to 4.4% from 3.8%. Slower growth and higher prices simultaneously? The word economists use for that combination is stagflation, and it's a word central banks hate. The reference forecast assumes the conflict is short-lived and energy prices rise only about 19% this year. In a severe scenario where the shock spills into 2027 and central banks are forced to raise rates, global growth could fall to 2%. That's a level the economy has only touched 4 times since 1980, and 2 of those times were the global financial crisis and COVID-19. For Canada specifically, this cuts unevenly. The US is cushioned partly by its status as a net energy exporter, projected to grow at 2.3%, the strongest of any major advanced economy. Canada gets a similar energy tailwind in Alberta and Saskatchewan, but Ontario and BC, our 2 biggest provincial economies, are energy importers. Higher oil costs sap household purchasing power there, and those are exactly the provinces where the job market and consumer spending are already fragile. As of today, Iran rejected a US proposal to suspend nuclear activity for 20 years, though oil prices slipped below $100 US a barrel, on optimism that talks could resume this week. The ceasefire expires April 21st. That date is the line between the IMF's manageable scenario and something harder to control. Last week, the OECD published a withering critique of the UK tax system, and almost every charge on the indictment applies here too. The OECD called for an in-depth tax review to make the tax system more efficient and growth-friendly by reducing distortions, closing loopholes, and ending reliefs and exemptions that do not serve economic or social objectives. The targets? Income tax thresholds that penalize people for earning more, sales tax reliefs that economists call regressive, and property taxes still based on 1991 valuations. The underlying argument is that the UK has a tax code that businesses have learned to game, and that ordinary taxpayers struggle to understand. Now hold that up against Canada. Canada's last major tax review was over 6 decades ago, the Carter Commission from 1962 to 1966. In the intervening 60 years, the Income Tax Act has grown substantially. New expenditures, anti-avoidance rules, and international measures layered on top of one another. CPA Canada has long called for a simplification review. On competitiveness, Canada's combined top marginal personal income tax rate of 53.5% in Ontario's ranks 5th highest out of 38 OECD countries, and its combined corporate rate of 26.1% is above the global average. The OECD's point and the Canadian point isn't necessarily about the level of tax, it's structural. Complexity falls hardest on small businesses, and rate traps at specific income thresholds discourage exactly the work and investment Canada needs as it tries to close its productivity gap with the US. The UK is being told to fix it. Nobody's telling Ottawa the same thing, even though the diagnosis fits. Eurodollar University covered a story about US life insurers quietly building enormous private credit exposure, with leverage that looks much lower on paper than it actually is, and with the real risk being mass policyholder exits that force asset sales into an illiquid market. Canada is running the same play. A recent survey found that 50% of Canadian insurers plan to increase their private market allocations, compared to 39% globally. And the big 3 have been acquiring private credit platforms at pace. Sun Life now fully owns Crescent Capital, a global credit manager with approximately $48 billion in assets under management, focused on non-investment grade credit, middle market direct lending, senior loans, and high-yield bonds. SLC Management, Sun Life's institutional arm, manages $260 billion of third-party assets, plus $165 billion of Sun Life's own general account. Manulife, meanwhile, completed the acquisition of 75% of Comvest Credit Partners in November 2025, creating an $18.4 billion private credit platform. Great-West Lifeco, operating through Canada Life and controlled by Power Corporation, is committing capital into private infrastructure credit through related vehicles. These aren't abstract risks. Manulife has $1.69 trillion in assets under management and administration. Sun Life has $1.6 trillion assets under management. These institutions hold the group benefit plans, segregated funds, and annuities of millions of ordinary Canadians. CPP Investments and Ontario Teachers are themselves investors in private credit strategies alongside and through these same channels. The concern Eurodollar University raised in the U.S. context was about leverage that's hidden inside affiliated structures, where a 2-to-1 regulatory ratio can mask 12-to-1 consolidated exposure. Canada's regulator, the Office of the Superintendent of Financial Institutions, or OSFI, has been watching this. In its 2025-2026 annual risk outlook, OSFI explicitly flagged the growth of private credit and its interconnectedness with regulated institutions, and is now developing a credit risk management guideline that addresses non-bank financial intermediation. That's the right instinct, but that guideline is still in consultation, and the build-out is already happening. Canada doesn't have the granular Fed-style analysis that showed one U.S. insurer's true leverage was 6 times what it appeared. We simply don't have that level of public visibility into Canadian insurer-affiliated entity structures. What we do know is the same industry dynamic is playing out here with equal enthusiasm. Sun Life's own asset management platform acknowledged in late 2025 that recent highly public defaults in specific corners of the private credit universe merit a more comprehensive look. The industry is flagging the question itself. That's worth paying attention to. 3 stories today in one thread. The risks that will matter most in the next 12 months are the ones that aren't fully visible yet. The IMF's downgrade is based on damage already done, not the severe scenario where energy stays disrupted into next year. The OECD's tax critique points to structural problems Canada has been aware of for 60 years without addressing, and on private credit, Canada's insurers are building exposure to an asset class that regulators are still learning to see clearly. None of these are reasons to panic. All of them are reasons to look past the headline number and ask what's underneath. Well, that's your daily brief for today. All credit goes to the creator featured. Their original analysis and videos linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.